Paytm is dead. That's what people were saying just a few months ago. Crushed by losses, exposed by scandals, and then publicly punished by India's central bank. The headlines were brutal, the markets unforgiving, and the regulators ruthless. But Paytm has done the impossible. It has announced a profit, 123 crore rupees in profits, the first in its entire history. To understand the significance of this moment, let's rewind to the rise, the fall, and the very public humiliation of one of India's most ambitious fintech firms. Paytm was the golden child of India's cashless dream. We thought it would change digital payments, and for a while it did. Over 33 crore registered users, over 2 crore merchants, QR codes everywhere, cashback on everything. Merchants proudly displaying their blue Paytm boards. Then came the year 2021, the grand IPO. In every way, this was the largest IPO in Indian history. 18,000 crore rupees raised. The company received a valuation of 1.39 lakh crore. The hype was insane and the fall was immediate. On day one, the stock fell 27%. Allegedly, 38,000 crore rupees of investor wealth disappeared. Just like that. The stock was now down over 75%. This was the worst debut in Indian stock market history. And it did not end there. In the financial year 22, the company lost 2,396 crore rupees. The financial year 23, another 1,776 crore rupees in losses. The thousands of crores burned in the name of growth. And then 2024, Paytm's worst year yet. The Reserve Bank of India was now involved. This was no longer just about losses. This was about violation of the law. This was about allegation that raised questions about data practices, including sharing data with related parties in China. The RBI stepped in aggressively. Paytm Payments Bank was barred from onboarding new customers. Everything from wallet services to onboarding affiliates had shut down. There were even partners walking away. Over 1,000 accounts that were flagged for irregularities. The ecosystem that Paytm created had literally collapsed overnight. Paytm lost over 600 crore rupees. Everyone thought it was finished. The end. But it wasn't. Something changed. Paytm began doing what almost all Indian companies avoid like the plague. Cut costs. Operating expenses came down by 15%. It cut expenses on employees. In the April 24 pay period, it laid off roughly 1,000 employees, over 10% of its staff. It cut advertising expenses, stopped bleeding money on vanity projects. In short, it started behaving like a business. It pivoted into lending, insurance, and device rentals businesses with less regulation and higher margins, instead of burning cash on user acquisition. It began monetizing what it already had. No more free stuff, just fees. And the result? A net profit of 123 crore rupees for the June quarter, with revenues of 2,334 crore rupees, up 8% over the previous year. The company claims it achieved this without any help from its now defunct payment bank. So is this a real turnaround or just a quarter of clever accounting? The jury is still out. But one thing is clear, Paytm is not dead. Not yet. It has recovered, and in doing so, it has sent strong signals to India's startup ecosystem. You do not have to burn thousands of crores to demonstrate value. Profitability is not a mythical beast. It is real and it matters. This moment will change how Indian unicorns think about businesses. Growth will not be enough. Valuation will not be a success. At some point, you will have to make money. But the bigger question remains, is this the beginning of Paytm 2.0? Or is this going to be a few months of sunshine before the next regulatory cloud comes along? Will the trust deficit disappear, or will it follow the brand everywhere? And more importantly, is India really entering the age of responsible startups? Think about it and share your views with us. Don't forget to like, share, and subscribe. Thanks for watching, and stay tuned to OneStats for the news that matters.